What's up everyone, and welcome to another video. In today's video, we'll be talking about inflation, what it is, the history of government spending, and how our current policies will impact inflation moving forward. So what exactly is inflation? Inflation is the decline of purchasing power of a given currency over time. We know this can be triggered by governments improperly managing their money and facing money problems.
Michael, are you having money problems?
Monkey problems? No, I'm not having monkey problems.
This decline in purchasing power can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. This basket of goods and services typically includes commodities such as food and grains, metal, fuel, utilities such as electricity and transportation, and services like healthcare, entertainment, and labor. As of October 2021, the inflation has picked up to a whopping 5.4%. The erosion of purchasing power can also be observed with the prices of everyday goods. Take coffee, for example. If you had purchased a coffee from Starbucks or Dunkin' around 1970, the price would have been around 25 cents. However, over the years, prices rise and the value of your dollar buys fewer goods and services.
What is the cash value of a Shroot buck?
Excellent question, Pam. 1/100th of a cent.
So let's dig into the index for inflation and understand how we measure it. Well, as mentioned, the Consumer Price Index, CPI, produced by the Bureau of Labor Statistics, or the BLS, is the most widely used measure of inflation. The primary CPI is designed to measure price changes faced by urban consumers who represent 93% of the U.S. population. It's an average, though, and doesn't reflect any particular consumer's experience, since some consumers buy more of one thing than another. Moreover, the CPI is constructed each month using 80,000 items in a fixed basket of goods and services representing what Americans buy in their everyday lives. Again, mentioned from gasoline at the pump to apples at the grocery store to cable TV fees and doctor visits. The BLS uses a survey of American families called the Consumer Expenditure Survey to determine which items go into the basket and how much weight to assign each item. Different prices are weighted according to how important they are to the average consumer. For instance, Americans spend more on chicken than they do on tofu, so changes in the price of chicken have greater impact on the CPI. Furthermore, the other method of calculating inflation is the PCE, or the Personal Consumption Expenditures Index. The Federal Reserve aims at a long-run rate of 2%, and I'm sure many of you have heard this 2% growth target, which is considered fairly healthy. A few differences between the two indexes. While the PCE includes more comprehensive coverage of goods and services and is conducted by the Bureau of Economic Analysis, the CPI is released by the Bureau of Labor Statistics and can also be more likely to be affected by categories with wide price swings such as electronics, gasoline, and housing prices. These differences are illustrated here. Alright, so now we know what inflation is, how it's tracked, and the overall gist of the term. Let's now dig into the three main types of inflation. Those are demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to price increases. With more money available to individuals, positive consumer sentiment leads to higher spending, and this increased demand pulls prices higher. The next type is cost push inflation. Cost push inflation is a result of the increase in prices working through the production process inputs. These developments lead to higher costs for the finished product or service and work their way into rising consumer prices. For instance, supply shortages with microchips and other transportation delays right now are causing many of the cost inputs to rise, and this is an example of cost push effect. Finally, we have built-in inflation, and this is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. As the price of goods and services rises, workers and companies come to expect that prices will continue to rise in the future at similar rates. As a result, workers would demand higher wages to maintain their standard of living, and their increased wages result in higher costs of goods and services. And as you can imagine, this wage price spiral continues as one factor induces the other and vice versa. Okay, so now we've touched on the types of inflation, but how is it really caused? The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth, and that is one of the root problems to really address. To combat this issue, it really falls upon a country's monetary authority, like the central bank, to help keep everything in check, aka Jerome Powell, if you know that name. For our knowledge, the money supply can be increased by printing and giving away more money to individuals, 2, by legally devaluing or reducing the value of the currency, or 3, and most common, by loaning new money into existence as reserve account credits through the banking system by purchasing government bonds from banks. With all that aside, let's look at the money supply in the US and how it has been trending in recent years. As we can see, the supply of money in the US has skyrocketed since the pandemic began, largely influenced by the succession of government stimulus packages to combat the COVID-19 pandemic. Again, we're showing the M2 money supply here, which includes coins and currency in circulation, checkable deposits, other deposit checks, and savings accounts. The broad supply of money in the US has increased from $15.5 trillion in February of 2020 to a staggering $20 trillion in January. This is a one-year record increase of over 30%. Let's repeat that. All of the money in circulation, 30% was created in the past year. I mean, if that doesn't blow your mind, I don't know what will. Well, why isn't there Zimbabwe hyperinflation then? Well, what has kept inflation moderately under control is that people have largely saved a higher percentage of their income this past year than they have in other years, as reflected by the savings rate. People in the past year have been saving much more than they normally do, investing in the stock market, which ties up money, and thus the real effects of inflation have yet to really come out. However, inflation has been more notable in recent months now that lockdowns are easing and people are spending more of their pent-up savings and overall incomes, causing inflation to be more apparent. So with all that printing that Jerome Powell is doing, let's take a quick peek of the inflation rate in the past few months. As we can see, inflation started picking up around April. Once lockdowns started lifting, people started spending more and savings started to be spent. Let's connect what we learned earlier to what we're seeing in today's economy. As we learned earlier, recent inflation is being driven by demand pull as consumers are seeking to spend more of their money post-pandemic, and cost push as a supply chain issue around the globe is driving supply costs up. What will be interesting in the coming years is as companies and workers expect higher inflation, will they also be increasing prices in contracts for labor, services, and other core services, which would increase overall inflation even more. If we zoom out further, we can also see that our current inflation rate is the highest it has been in the past few years. We've historically aimed at 2%, but clearly that 2% has grown upwards to near 6%. And then if we expand for the past 80 years, we can see that inflation has been fairly rampant in certain time periods. For the past 20 years, inflation has been controlled sub 5%. However, that hasn't always been the case. In the late 1970s in America, prices were rising fast. In other words, inflation was running rampant, usually thought to be the result of the oil crisis in that era, government overspending, and the self-fulfilling prophecy of higher prices leading to higher prices. We also saw inflation expand post-World War II as spending was encouraged, and we've seen it increase during the Korean War, the oil shocks in the 70s, and other war events. The final element worth mentioning is the role of government and its spending habits. The spending habits of the government also play a role with inflation since their policies reflect how much money is actually being spent. Looking at data since 1901, federal government receipts and expenditures were mostly in line up until the early 1970s. I think this chart is super interesting. Sure, we had a deficit at times, including World War I, the Great Depression, and even World War II. Even then, Washington had some measure of control over spending as the country was still under the gold standard. However, when Nixon abandoned the gold standard in 1971, the shackles were removed and Congress was free to spend, or rather overspend. In more recent times, Washington's propensity to overspend has been unparalleled. When the financial crisis hit in late 2007, Congress passed a series of spending bills known as quantitative easing to help the country emerge from the Great Recession, Back then, expenditures were about 67% greater than receipts. And again, for clarification, receipts are revenue generated by the government through income taxes, payroll taxes, and general taxes, and expenditures are the opposite. It's money outlays. Overall, the COVID-19 pandemic has ushered in a new wave of spending and expenditures, surpassing receipts by nearly 92%. So our government is spending much more than it's bringing in to offset the impact of COVID. And this spending only adds to our national debt levels. When you look at the national debt over an extended period, you can see how it's spiked in recent years. Some of that has been driven by COVID spending, but there has been an uptrend in the US on its spending. Simply put, the US government is leveraging its future to stimulate today's economy. The US national debt is hovering around 30 trillion, an increase of 5 trillion in just over a year. Even without additional spending, the national debt is expected to approach 90 trillion by 2029. The government's debt to GDP is already clocking in over 127%. This may have you wondering why the US is spending so much. Yes, America is losing, or perhaps already has lost, control of its public spending, but it hasn't always been that way. Washington is now debating an infrastructure bill with a price tag of around $1 trillion for the bipartisan bill and $3.5 trillion for the Build Back Better Act, an infrastructure bill looking to improve infrastructure to combat climate change, healthcare, and education. Do we need to address our infrastructure? Yes. However, is this the right time to add another few trillion in spending? I'm less certain. That's why there has been pushback to pass such an aggressive spending plan now, when everything from houses to stocks to our daily purchases have been so inflated. As Winston Churchill once said, you never let a serious crisis go to waste. Governments have an opportunity to do things they couldn't have before. I believe this theme is underpinning some of the actions in Washington. So let's recap what we've learned. 1. Inflation is the deterioration of purchasing power and can be driven by demand pull, cost push, or built-in inflation levers. Government overspending increases money supply, which makes your dollar less valuable. 2. Interest rates are high now at 5%, but have historically been higher during certain periods in U.S. history. However, excessive government spending and a buildup of debt have been noteworthy since 1970. Low interest rates have only further stimulated the economy. If saving rates drop and money is spent more quickly and frequently by consumers, inflation could pick up even more. 3. Current government spending in an already overheated market can further push inflation if counteracting measures aren't incorporated. I hope this video helped to outline what inflation is, the role it plays, the history of it, and other areas to better inform you. If you're interested in these types of videos and want to see more of this content, please make sure to like, comment, and subscribe to stay updated. Until next time.